let's go ahead and get into it. Leverage. When we are buying options, actually when we're trading options, whether we're buying or selling, I'd like to say that there's two questions that the investor needs to ask themselves. Number one, first and foremost, is what is my forecast? Where do I think that stock is going to go, or whatever that underlying asset may be, whether it's stock or an ETF or an index? Where do I think that's going to go? Is it going to go up? Is it going to go down? Is it going to stay the same? One of the beauties about the flexibility of options is that regardless of market movement, there are strategies out there designed to help you profit. So when you buy stock, obviously we want that stock to go up. If it goes down, that's not going to work out too well for us. With options, we can choose a strategy that allows us to benefit when the stock goes up. We can choose a strategy that allows us to benefit when the stock goes down, or we can choose a strategy that allows us to profit if the stock doesn't move any direction whatsoever. So these are just some of the differences, use cases of options versus stock, but we need to ask ourselves is, where do we think that stock is going to go, and how long is it going to take to get there? That's that second part. That's going to be that expiration date. So with a stock, you can buy it and hold on to it theoretically forever. But because an option is a contract, like all contracts, it has an expiration date. They're only good for a certain period of time. So we need to make sure that the option that we're looking to purchase or sell, for that matter, that we are choosing the appropriate time frame for two reasons. Number one, if we're investing for an earnings event, let's say that's coming up 3 weeks down the road, then it does us no good to trade an option that's going to be expiring 2 weeks from now, right? So we want to make sure that if there's an event that's going to occur, we want to make sure that that event occurs within that time horizon that our option offers us. The second reason that we want to know is because time is money. Just like with any other really thing in life, time is money. It's really prevalent when it comes to options. And simply because if I'm a seller of an option, I'm incurring a risk. And the longer I'm holding that risk, the more I have at stake. So I'm going to want to make sure as an option seller that I collect enough premium, right? That's what we call the price of the option, the premium. I want to make sure that I collect enough premium to cover that long-term risk that I have. So that means that longer-term options are going to be more expensive than shorter terms. So it's going to be kind of a trade-off. For example, if we're looking at that earnings example again, I want to make sure that the option I'm purchasing covers that period between now and that earnings event, but I don't want it to cover much more than that because I'm going to be paying for all of that extra time that I may not necessarily need or want. So we start with the forecast, we follow it with an expiration date, and then we select a strategy. If we're looking to buy options, are we looking to purchase calls? Are we looking to purchase puts? Are we maybe looking to buy a spread of some kind? And then we should also have in mind an exit strategy. There's a saying that we have on options, plan the trade and trade the plan. So not only is it important to know when to get into the position, but it is equally as important, and sometimes even more important, that we understand when to get out of that position. So these are just some of the questions that we ask ourselves that we really need to address for ourselves before we start plunking down our hard-earned money and investing with options. So the thing about leverage is it offers us what we call more bang for the buck. You can buy 100 shares of stock trading at $100 a share and invest $10,000. You can take that same $10,000 and invest it in options and generate significantly higher returns, or I should actually rephrase, you can potentially generate significantly higher returns simply because you're able to capitalize on the leverage that options offer. And here's an example. Here's a scenario that we can look at. Due to recent events, Lindsay is extremely bullish on pharmaceutical stocks. To speculate on the industry as a whole, she's found an ETF that groups several of these companies together. Stock's currently trading $50 a share, and she can buy 100 shares of stock and invest $5,000 by buying that stock. Or she can buy a $50 strike call and for a 6-month period at $4.50 per option. Okay, so for that same $450, she can control 100 shares of stock at $50 a share. So it's a significantly lower capital requirement trading with options than trading with stock if we're just going 1-to-1. And let's see what might happen here if this is the plan that we do. Rather than just buying that one option for $450, Lindsay's going to go ahead and purchase 11 of these. So rather than investing $5,000 in stock, she's going to invest roughly $5,000 in options. And here's what things look like. If we just take that $50 stock price and stock doesn't move at all, at the end of that 6 months, her 100 shares of stock are still going to be worth $50 a share or $5,000. So there's not going to be any gain, any loss in her portfolio. She's going to see everything relatively flat. The thing about buying options, though, is that we need something to happen. There's a concept called time decay. And what time decay basically tells us is that with each passing day, our contract is going to be worth less. You can think of options as a decaying asset. As each day passes, that option is going to be worth less than it was the day before, assuming all other factors remaining constant. So if that stock doesn't move, her stock portfolio isn't going to change. That's not going to be a problem. But we need that movement as option buyers in order to gain that value. So if things don't change from day 1 to day 180 when that 6-month contract expires, we're going to lose that entire option investment. We're going to lose all $4,950 that we invested. That's going to be 100% loss. One of the risks with options, right? Obviously, there's no reward without risk. And as we have an elevated potential for reward investing with options, there also hand in hand is going to be that elevated risk. So if things don't operate as we expect them to, remember, we're starting with a forecast. If our forecast is wrong and that stock isn't increasing, that's going to cost us money. Now, if conversely, things do go our way, let's say we were bullish, we thought there was a lot of room, the stock was $50, now it's trading $60. So we made $10 per share. In our stock account, we had 100 shares, so that's a $1,000 profit off of our, $1,000 profit off of our $5,000 investment. So that's going to be a 20% gain in that stock portfolio over 6 months. Not too bad. I think most people would be pretty happy with that scenario. By going with options instead, we've got a 120% gain because now that option, that $50 option that we paid, $4.50, it's now worth $10. So we've got that significant increase in value. And because we bought so many of those options, that same $5,000 with stock, it's now worth a $6,000 position. With our options, it's now a $6,050 position. But the difference is we only invested $450 versus the $5,000 with the stock. So that's kind of how leverage works. It gives us a potential for some tremendous upside gains. But again, the downside to that, the balance to that reward is going to be that risk. If stock doesn't perform as we want, if it doesn't move upwards from 50 like we need it to, if it stays stagnant or worse yet, it even drops, we're going to lose 100% of our investment. So that $4,950 that we invested rather than the stock, those the funds are gone from our option. So it's almost like a double-edged sword as people refer to. So leverage can work out great, terrific returns if things behave the way that you're expecting them to and you're forecasting. The downside to it is that obviously you have increased risk as well.